The Federal Reserve's latest move, a 25 basis point rate cut, has sparked fresh waves of optimism across Wall Street, with investors embracing the notion that easier monetary policy will help extend the current rally. Lower borrowing costs have long been a catalyst for risk-taking, and the market's immediate reaction reflects that familiar pattern. From small-cap stocks to growth-focused companies, bullish positioning has gained traction as traders begin to recalibrate their expectations for the months ahead. Yet beneath this upbeat response lies a more complicated story, one in which risks remain firmly in place despite the central bank's efforts to provide relief. The psychology of a rate cut cannot be overstated. For equity markets, it represents not only a direct reduction in the cost of capital but also a signal that the Fed is willing to step in to cushion the economy against turbulence. This vote of confidence has emboldened investors to move into riskier assets, extending momentum beyond the mega-cap technology stocks that have dominated for years. The Russell 2000 surge to record highs illustrates how smaller companies, often more dependent on favorable credit conditions, stand to benefit from the Fed's easing. The cut has also supported a renewed interest in cyclical sectors such as financials and industrials, both of which are seen as sensitive to shifts in economic growth and interest rate policy. Still, the optimism generated by the rate cut is tempered by a stark reality. The Fed is easing because the economy is slowing. Tariffs continue to weigh heavily on businesses, supply chains remain under pressure, and signs of cooling demand are evident in both manufacturing and services. Rising inventories hint at sluggish consumption, and despite the boost from monetary policy, many analysts argue that rate cuts alone cannot resolve the structural challenges facing the U.S. economy. For that reason, investors may be underestimating the potential for downside risks if the economic slowdown deepens more than expected. Another concern is valuation. Even as rates move lower, equities are trading at historically high multiples, particularly in technology and growth-oriented names. Fed Chair Jerome Powell's reminder that markets may already be fairly highly valued underscores the danger that rate-driven exuberance could inflate bubbles in sectors already priced for perfection. If earnings growth fails to keep pace with these valuations, the risk of a sharp correction looms. Global dynamics also complicate the picture. The U.S. is not operating in isolation, and international pressures, ranging from geopolitical uncertainty to sluggish global trade, threaten to dampen the effectiveness of Fed easing. While investors are currently focused on the domestic benefits of lower rates, any escalation in trade disputes or broader global weakness could quickly offset the positives. For now, Wall Street appears content to focus on the near-term benefits. Risk-taking is back on the table, confidence has improved, and the Fed's move has injected fresh energy into sectors that had lagged behind the tech-driven rally. Yet the delicate balance between optimism and caution remains. Monetary easing can spark rallies, but it cannot eliminate the deeper structural risks that continue to shadow the U.S. economy. The latest cut may have provided the spark, but whether the fire sustains itself will depend on factors that extend far beyond the Fed's reach.